Hey everyone, Austin Swanson here, aka 24/7, bringing you a video today on a detailed investment analysis on the first rental property I ever purchased and ended up selling. So I have from start to end, from purchase, rehabbing the property, renting it out, refinancing, and then buying another property, so B.R.R.R., and then selling that property. And so I have all the numbers. There's a few areas where there's just like I had to round a little bit, but otherwise I went through all my what I sent to my accountant at the end of last year, my closing documents, from the purchase, the refinance, to the selling, and try to get everything as exact as possible, so that I could make sure I completely figured out all the numbers, exactly what I invested and what I made from this property. So let's jump into it. So to kind of guide us through this discussion, I did a full detailed write-up, investment analysis, very similar to what I did for Cardlytics on my Substack. So I posted this real estate investment analysis on this first property on my Substack, and you can view that in the links down below, but I'll be walking through it here. So to give you an overall picture of what this is about, I use the B.R.R.R. method that we already mentioned to buy a property essentially with none of my own money. So I kind of made B.R.R.R. even better because I didn't use any of my own money to buy the property or rehab the property. I used a loan, and in total, after rehab or refinancing and selling, I netted about $20,000. And that took about a year and a half, 16 months, and there was really minimal work and minimal rehab. So right away on the surface, just kind of to let you know my thoughts on that is I'm happy with that because, I didn't use any of my own money. So you can imagine if I scaled this and took on a lot more debt, essentially, to purchase more properties, I could, get a multiple of $20,000. So this was a really good proof of concept, and I've actually used this proof of concept to buy more properties with more debt, and actually used similar strategies for buying public companies, and I'll talk about that all here. So we're going to focus right now though on this specific property and all the numbers. So I purchased property January 31st, 2020. I actually purchased two properties at that time. These were the first properties I ever sold or ever bought, and then this was the first property I've ever sold, or investment property, and I sold it about a year and a half later, on just last week. So this is all very recent, and as I said, did the full B.R.R.R. process, and I just thought this would be a really interesting analysis because I have every single part of the cycle with this deal, and I have all the numbers, and I'm a numbers person. I'm an actuary, right? So I thought it'd be fun just to know as close to the penny as possible what this investment was like. Here's just a picture. This is post-rehab, and we'll discuss all the rehab and the before and after pictures, and this was the picture used for listing. So purchase, January 31st, 2020, it was $77,000. Pretty cheap. This was an off-market deal. It was an investor who had a lot of properties, and I was trying to buy three at the same time, so I actually got a good deal. One property I didn't close on, but I did on two. The other one, the bank at the last day, I believe, or very close to the last day. It was really close to the end. They're just like, oh, something happened. They couldn't do a loan on that property, even though it passed all the inspections. It was a weird situation. But on the other two, I did purchase. But we're only talking about one today because I sold that property. At the beginning, I did a 30-year mortgage, 5% interest rate. It was a little bit higher. The reason it was higher was because it was before interest rates started declining so much. It was also an investment property, which interest rates are slightly higher, and it was a low loan amount, and so interest rates were also higher for that amount. And then 20% down. So cash to close, if I did 20% times $77,000, that gets me $15,400 plus $3,700 approximately for closing costs, and another $350 for inspection. It's a total of $19,500, right? And that's right down here. Again, I used a HELOC. So I used a HELOC to fund that amount. The difference between these two is the rehab costs, and we'll get that down below. So again, used a HELOC. I have made videos before. I just posted one on YouTube of how I purchased a property with a HELOC and the risks and benefits of it. The risks are, you're using your own primary residence as collateral to get money to buy a property. Right? It's a loan, so it's not your own money. You're borrowing it from somebody else. But if you don't pay that back in the interim or at maturity, they have your primary residence, or maybe some other property that you're able to get the HELOC on, but they are able to take that property from you. So the big risk is not being able to pay that interim monthly amount or the amount on refinance or the amount at maturity. And so what I did is I ran my numbers. I mean, I have the calculator I use all the time. Link will be down in the description. I ran the numbers, and I was running numbers on tons and tons of properties until I got to this one, and I was like, wow, I am going to cash flow quite a bit, and I was. I mean, we'll talk about this more later, but cash flowing over $300, and then after refinance, still able to cash flow, and then once I refinanced, I was able to get all my money back and an additional $10,000, and so the numbers work great. And so I knew I could pay the HELOC balance or the HELOC amount every single month, and then when I refinance, I could pay off the HELOC entirely. So that was a major benefit of this. So Rehab. Rehab was really minimal. It wasn't a lot of work, as you'll see in the pictures. I used my bookkeeping to get as exact as possible. But the only ones I couldn't get exact numbers on were paint, landscaping, electrical. But those were pretty dang close. And so the 6,000 is exact, but I used the miscellaneous kind of as a plug and a catch-all for all the other little expenses. So again, $6,000 is pretty dang cheap overall. So here are the pictures. Kitchen, right away, everyone I talked to was like, oh, why'd you paint the cabinets? They were so nice. And, I've had others tell me in the past, they're like, painting kitchen cabinets or other cabinets is like everyone who used to put carpet on hardwood, except, if you took out the carpet, you still had the hardwood, where this, I kind of, ruined these nice cabinets. I agree, right? But here's the thing, right? Is if I did not paint these cabinets and make them more modern looking, what you would see in, maybe in a brand new home or brand new build, I don't think it would have appraised for as much as it did. And I purchased for $77,000. It appraised for $134,000, and then I sold it for $123,000 or $124,000. And I don't think I would have got that because it doesn't look as nice and updated. Your first thought when you see the old cabinets, although they're nice, they're old looking. It looks outdated. And then boom, right away I paint it and it looks way more updated. Other things, got a new light. That was probably about $100. Got a new oven and microwave, and then updated the cabinets and got new handles. All very cheap. Bathroom, got a brand new light, brightened the place up, got a new fan in there, got a new mirror. I think I just got that one at Walmart, and then put an accent wall. The accent wall, I think, it looked nice trying to make this room that wasn't very nice look like something. I wouldn't do that in a nicer home or a nicer, property, but in here, it worked out pretty well. Laundry room, we just got a new washer dryer. As you can tell, pictures that we just, getting a nice picture with good lighting and nice angles helps a lot. It helped a lot for renting out the property as well as then selling the property. But these were our photos for renting out, not selling. Bedroom, we only changed the blinds, and we left all the paint was at what it was when I bought the property. Carpet was already there, so it was actually really nice. And then we changed out the doorknobs to get something stainless or satin nickel. So for our pictures, as you can see, this is a blow-up mattress. We use that when we stayed the night for trying to rent out the property because we bought this out of town. This wasn't where I live. We bought it out of town. So when we would do the rehab and everything else, we would stay the night, and it worked out great because I had friends in that town. So it was a great excuse to go there. But the reason I bought out of market where I live is because it was a much better rental market, and that actually proved out to be exactly true. I was able to rent this out for way more than I could where I currently live, but purchase the property at the same price. Actually a really good price in relation to that rent, well exceeded the 1% rule. And yeah, but anyways, the other reason to have blow-up mattresses is right away when we started renting it out, we didn't have these in there, and people are like, oh, can you fit a queen bed in here? And so we're like, well, let's put a queen mattress in there and leave it in there for tours so people can actually see that, yes, this works. So rent, it's much easier if I just walk through. I'll walk through all of that description right here, and I'll just open up a new page. So pre-refinance, I was pulling in $995 a month in rent. Our expenses were about $689, cash flowing $306, right? This was kind of my estimate of what was going on. Rent was exact. That was exactly what we got. Cash on cash return, you take your monthly your cash flow times 12 to be annualized, and I think that's divided by the 25,000 if I recall right. Cap rate is the NOI, net operating income. Essentially, you're backing out principal and interest, as well as in this case I backed out CapEx. It's something I've seen for other NOI, so I wanted to make it more comparable, and so that gives me about a 10 cap or 11 cap, and then debt service coverage ratio is your NOI, essentially how much income are you bringing in to cover your principal and interest. And so post refinance, my numbers stay the same. I still had a tenant in there, and it was cash flowing or rent it out for the same amount. All the expenses stay the same, except now principal and interest increase because my loan balance on the refinance, I believe that's the next section. Yep, the next section. So we'll get into it there. But it went from my original loan balance was about $61,000 and then went up on the new appraisal at $134,000 to a loan balance of 75% of that is $100,500. And so that gives me a cash flow per month of about $200. Still pretty good. The cash on cash return goes negative because now I'm making $193 a month or annual, times that 12 to get the annualized figure, but that amount annualized divided by a negative amount because on the cash out refinance, I got all my original amount back plus an additional $10,000. And so it was essentially I received $10,000 and I'm cash flowing this. So it wasn't like I paid anything like in the original sense where you paid $25,000 to get the monthly cash flow. I was actually received $10,000 and I got this cash flow. So that's why it became negative. But the cap rate, so as you'll see, the NOI stays the same because the rent stays the same, the income or the revenue, and all the expenses stay the same. The principal and interest increase, but that's not a part of NOI. So you would think, well, why doesn't cap rate stay the same? Well, technically post refinance, I did it on the purchase price plus rehab because that was essentially what it cost to buy that income, excluding debt. And then debt service coverage ratio, again, NOI stayed the same, but our loan balance increased. In total, I rented this out for 11 months. And this is where, why the cash flow is so much lower in a total of 16 months, right? It was only $1,000 that I cash flowed, which is still fine, right? I broke even. I didn't lose money. This is true cash flow after principal and interest, after all the expenses, everything else, right? So I'm still happy with that. But I was vacant for 5 months. You had vacancy when I purchased the property and before I rented it out. I was rehabbing it and then trying to rent it out. And then once the tenant left, we had to sell the property. Instead of just turning it over and selling it, we had to try to sell it. We would have had even less vacancy. And during that vacancy, you still have all these other expenses. I'm still paying the mortgage. I'm still paying. And then now I have to pay utilities. I had to pay for mowing and other expenses because before, the tenant was paying for all that. So my expenses were actually increasing. But once we were selling the property, the first sale actually fell through, and we'll discuss that later. So then I had to relist it and then sell it again, and so that made that process much longer, increasing vacancy, not collecting rent, decreasing my overall cash flow. But overall, about $1,000, still positive, which I'm content with. So we did a refinance almost exactly a year later. And that's not because there was a 1-year seasoning period. There was actually only a 6-month seasoning period. But the way things worked out, it just worked out really well of how I did the refinance because I purchased more properties later in the year. I refinanced all of them at the exact same time with one loan officer, which was really nice. And then I used those proceeds to purchase another property, all on the exact date, 1/4/2021. So it worked out fine. The appraisal came back at $134,000, which was actually higher than what I thought it would come back, which was great. If you take 75% of that, you get $100,500. So that was my new loan amount. That a new loan amount, if you subtract out what my previous loan amount was, and that's lower than before because it gets paid down over time. You pay that off, and then after the closing costs, I received $35,629. That was my cash out amount. As you remember, the initial purchase price or down payment plus closing, inspection, rehab was $25,000. So I paid $25,000 and then I received $35,000 in the refinance. So essentially I paid $25,000, received the $25,000 plus an additional $10,000. And I could use the total $35,000 to purchase my next property, which I did. The other aspect of this, remember, is I used a HELOC. It wasn't even my own money. I mean, it kind of was, because we already discussed that. But I took out a loan of $25,000, and then so I had a HELOC balance that went up to $25,000. Then I received $25,000 back, so my HELOC balance went back to zero, and then plus an additional $10,000. And that's where we get the $10,000. We at purchase plus rehab, we spent $25,000. And then after the refinance, we paid off the $25,000 and then received an additional $10,000. My interest rate actually went down to 3.375, which was nice, but another 30 years. And it was at 75%. So on the cash out refinance, it instead of doing, even though on purchase it was 80-20, it drops down to 75-25, at least with my banks. Okay, this brings us to the sale. So we sold the property just last week, May 27, 2021. As I said before, it was great. We sold we listed the property, and the first day I think we had multiple offers, and I accepted an offer, full price, no inspection contingencies. I was ecstatic, because maybe one thing I did mention, and we'll get into this even a little bit more, is this property was built in 1897. 1897. So you saw the pictures. I mean, it doesn't, everything seems fine, right? And everything is fine. We've done the inspections, and there's nothing wrong with the property. It's just, it's older, right? But I was super happy about selling this property and no inspections. It was going to make a nice, clean sell. But a week or two before the sale, the buyer ran into issues on their loan, and they essentially took out more credit when they weren't supposed to, and the bank said, nope, now we can't give you this loan, so it fell through. Yeah. And so then I had to relist the property. And so I was really nervous, because once we listed it, all that record shows of a property still, like on Zillow, it shows that it was under contract and then it was relisted, but it still shows days on market was like, now over 30 some days or 40 some days up to I don't remember if then, because then what started happening is the market, people start questioning, well, why is it on the market for so long, even though it fell through, or why did it fall through, right? Even though it was nothing to do with the property, it was all on the buyer's side. So we weren't getting as much traction, but all of a sudden we got an offer and we negotiated it, and we the amount we agreed on was $123,900. And my asking was $124,900, so only $1,000 less, which is fine. We did pay for closing because, again, I wasn't getting much offers at this point like we were at the beginning. I was nervous that, I didn't want to just say, no, I'm not going to pay for closing. They walked away, because I was, you could have just did the same of saying, what if I got $121,900? I probably would have been just as happy at this point. And then, so this was contingent on inspections. They came back and they had a long list of items they needed fixed, right? Tons and tons of things. And it was, I can't remember if it was like tens of thousands of dollars worth of stuff. It was a lot. But I learned a trick. When I purchased my first primary residence, I remember being, I was really emotional. I wanted the property. And I had all these things that after my inspection, I'm like, this needs fixed, this needs fixed. And the buyer came back, the seller came back, and they're like, we'll give you $2,000. I was like, well, okay, I want the property. I let my emotions take over. Well, now that I'm the seller and I'm, and it's more of an investment role where I have less emotions, I'm not all excited about the property. I remember that strategy. And also I used from what I read from Never Split the Difference, Chris Voss. And I remembered of using a very specific number. So I came back really low, encountered with 1,125. And maybe that's, it's completely arbitrary, right? But for them, they might think, well, that's really specific. Maybe he thought about that, and that's what it's actually going to cost. Sure enough, they accepted it. So maybe they would have accepted $0, but I felt fine with that. I tried to be fair with what I was doing. Closing costs, I did use a realtor, so that's why that increased. It was about $9,000, and I was fine with using a realtor. I like building that relationship and using my same realtor on the buy and the sell side, so they essentially got commission on both sides of it, and that also makes them more likely to bring me more deals in the future if I'm going to use them to sell. And so in total, I, on the sell, made an additional $10,000. So as you can see on the refinance, we made $10,000 or got $10,000 back. And then we got an additional $10,000 once we had the 123 after paying, paying off the existing mortgage, paying other expenses, we were left with an additional $10,000. So here's a summary of it. I'm going to zoom in and get to where a little bit more specific here. So as you remember, we spent $19,500 at purchase. Our rehab was about $6,000, which gives us a total investment of $25,000. We refinanced, and on our cash flow refinance, we got $35,000. So we paid off the existing $25,000 and got $10,000 back. We sold it, netted another $10,000, so a total of $20,000. Then from the $25,000 investment, netted, got our $25,000 plus an additional $20,000, and then so we almost doubled our money, 84% return when you include the $1,000 of cash flow, and then annualized, because it was 16 months, was about a 58% annualized return. I also do the comparison of saying, I didn't actually, this wasn't my money, and so it didn't really cost me anything to buy this property. But I like thinking about, I did borrow this money, this $25,000, and I could have used this $25,000 elsewhere and maybe buy, a certain public company investment that would have went up 3 times in the same time period, or even better, right? Luckily, I had some of those that I could have invested in, but it's hard to say. Like I think overall I'm very happy I did this because I learned a lot, and it kind of changed my frame of mind of thinking about, investing in real estate versus public companies versus commercial real estate, triple net leases, absolute net leases, and other, aspects. It opened up a whole new world to me, and I learned way more than just reading or listening to podcasts, watching videos, whatever. I learned so much more from doing this that I'm very happy with it, and I'm glad. I would have just been happy to get my money back, right? I'm very happy that I actually made a profit off this, and because it was such it's a small property, and I'm content with that. I'm happy overall. So as we talked about, total 21,000. So why I sold it. One, well, kind of back to where I was talking about other investment opportunities. Now I have some that I'm more concretely thinking about that I'm like, these are going to do probably pretty well in the future. I believe they are. And so I'd rather take that money and invest it elsewhere, which is in those investments. In addition, as I said, this property was built in 1897, right? I can't imagine holding this for 30, 50 years without significant capital expenditures, more than I originally planned for. So I thought, if I'm not going to hold this forever, maybe I should just sell it, because that's kind of why I want to hold real estate, is for the long term. And finally, I wanted to use this seller's market to my advantage, right? I thought that under a typical market, even just a year ago, I would have had issues with this property. There was certain aspects, such as like the crawl space or basement was a little weird. And that was actually the feedback we were still getting when we were listing this property. I just thought that there was going to be no way that I was going to sell this to someone who's going to live there. Because of this space, I just thought people were going to be too picky about it. And so I thought maybe the only way to sell this was to another investor, and which I would have probably had to sell at a much lower price. So I was actually really happy to sell it in this market, capitalize on it, and pull out this money and invest it elsewhere. But by selling it, I'm giving up the future return potential of this investment. So I like thinking about, how good this property could have been. So here's a full report. I produced this with the calculator that I created. Again, link down below for this calculator. But it produces this report, and it's actually really nice to look at and save off. But we have all our numbers, the 25,000 that we originally used. Let me see if I can zoom in a little more. Yep, 25,000. We got the $10,000 after post refinance. Here's the breakdown of the expenses. Again, most of the expenses are the mortgage, but the more important thing that I want to look up is what I gave up, right? Cash flow in the short term was okay. But over the long term, what you have to think about is, cash flow, I have here, let me show you the assumptions. So we have 2% appreciation in the value of the home, 3% rental increases, which is exactly what we do to our current tenants and plan to keep doing every year, no matter what, no matter if the tenant's the most amazing tenant in the world, because what can happen is if you don't increase it for 10 years, now you have this large gap and you're not going to be able to increase it on them. You want to have a steady increase, let alone keep up with the expenses, which we assume are going to grow by 3%. But your mortgage is staying the same, a little bit of operating leverage in a way. And so you have this widening effect that although some of the expenses are growing at 3%, you're having a higher percentage of your total, the rent is much higher. And so that's increasing. You have this widening effect, and you get to, in the last year, about $12,000 in cash flow. And we also just assumed lower monthly repair and capital expenditures here. But I also wanted to say, if this investment worked out really well, what am I foregoing? So that's kind of why I kept them that way. Vacancy, 8.33% is 1 divided by 12, or 1 month of vacancy per year. And then we manage our properties ourselves. And so as you can see, total equity, cumulative equity earned is, upon our down payment, how much this is actually growing by, and then plus the down payment, get 128,000. Or 128,000, 238,000, plus our total amount of cash flow. And I assume 0% reinvestment of cash flow. I could take that cash flow and invest it elsewhere, but just to make things more comparable, I'm going to assume 0% with that cash flow. And so total, I foregone essentially almost $500,000, $463,000. But that's 10% annualized on the original 25,000, I believe. If I take 25,000 times 1.10, there's probably some rounding here, and I take that to the power of 30, 436,000. So approximately, right? That's where that number's coming from. And so it's like, can I earn more than 10% on my total, 20-something thousand or all my money, right? And I think so, right? I really think so. I think, again, that's based on the original investment. I got my 25,000 back plus an additional 10,000. So now I'm at 40,000. And it's like, can I get 10x in 30 years? honestly, I have my current investments that I'm looking at. I think I can do. I have ones that I think could be worth more than 10 times in 10 years or less than 10 years. And so I'd rather take that money now and invest it elsewhere. And that's exactly what I'm doing. So final thoughts. Overall, not a lot of work involved, right? You saw the updates, not a lot to do. The rent, we found a great tenant, so that worked out really well in the interim. The refinance worked out really well, and the selling worked out in the end really well. Without the HELOC, it would have been a 58% annualized return, which is really good. With the HELOC, it's an infinite return because I didn't use any of my own money. And that was probably the best thing about this is I proved to myself that I could borrow money. That was a little bit more safe. It didn't have margin calls. Wasn't really, had too much callability. And so it gives me confidence to do this elsewhere. And that's actually what I've done for buying my duplex at a much larger scale and with a different strategy that I'll talk about in the future. And it also helped for, I've bought public companies in a similar fashion. And so using this different form of debt, right? I don't like using margin. I don't like the margin calls. The fact that if my price goes down and I posted that same stock as the collateral, that's the exact time I want to be buying, not posting more money to collateral. So anyways, overall, I'm very happy with this. I'm glad I broke even and made some money. I learned a ton. And I'm interested to see what will happen in the future. So if you have any questions, pushback, whatever, feel free to reach out to me. My Twitter right here, 24/7, website, 247.com. Additional resources, I put the calculator down here. It has a link. I have tons of them, but the one I've been using is for the rental spreadsheet. That's what you kept seeing here. And there's also links to everything else down below, my social media and other links. So I hope you enjoyed this detailed analysis. It's something I'm always curious about. I'm always curious about the numbers and being an actuary, and that's just what I love, right? I don't necessarily love all the more manual labor. I love analyzing stuff. I love analyzing on purchase, and I enjoyed it on the sale. So I hope this was interesting, and I hope maybe is useful. And I plan on keep doing these in the future. So again, this will be posted on Substack. Link down below. And everyone, thanks for watching, and I'll see you in the next one.